the easiest way to grow your crypto trading account. In this video, I have a bunch of resources for you so that you can actually analyze the market, but also just the broad categories of where we can actually invest and the risk and return that we should expect from that. Everything is listed as timestamps. There's a step-by-step guide, so look in the description for the timestamps and all of the resources that I'm talking about in this video. Let's start with what the easiest way to grow any investment account is, especially within crypto. We have to look at Bitcoin and Ethereum, the returns that they're actually going to give us over a few year time period, and then the ways that we can outperform them. Because the only reason you would actively trade is to try and outperform a passive investment strategy. So what's the easiest way to make gains? Well, obviously it's just to buy Bitcoin and ETH, right? But what does that actually mean? Like, what are the data points here? So the first thing we can look at is something known as CAGR, or compound annual growth rate. This thing right here, compound annual growth. What we really want to know firstly is how much do Bitcoin and ETH grow over cycles generally? Because if that's good enough for us, then we don't have to do anything else. Maybe we want to outperform them. We need to know how much do we need to actually earn per year to outperform just buying and holding those. So compound annual growth, this is Bitcoin right here. Now I'm looking at this on Glassnode. I'll leave a link to them in the description. I think if you sign up for an account, you actually get this for free. There is a bunch of indicators that you can get for free with Glassnode. You can check the details via the link. Most of Glassnode is paid though, so you won't be able to see it unless you pay, but Glassnode is industry standard for all of this data, so it is a good resource. So what we can see here is CAGR for Bitcoin, and what we can see right now is that the compound annual growth rate for BTC is around about, let's call it 50%. So this is a 4-year CAGR. So I'm going to get myself out of the way right here so you can actually see that down here where my cursor is. If you hold Bitcoin for 4 years, you should on average make per year around a 50% return. Now that obviously has a lot of volatility in it, drawdowns, bull markets, bear markets and everything, but this doesn't lie. This is a metric that shows that over time Bitcoin is, for right now, having a CAGR of around 50%. If you hold for 4 years or more, which is around one cycle, right? So you have to dollar cost average and buy during that cycle. And of course you can time the market, but we'll get onto that in a second. Now, as you can see, Bitcoin as an investment, the CAGR, or the compound annual growth, is actually going down. This is completely normal because it's a maturing and larger asset. And so mature large assets simply don't grow as fast. They just don't have the ability to grow as fast as smaller assets or more youthful assets that still have more growth in them. Bitcoin, of course, compared to stocks or anything, still has huge amounts of growth. So as we can see, if you just buy and hold Bitcoin over the long term, especially now, your compound annual growth is around 50% per year, which outperforms every other asset class known to man. Stocks are 8%, QQQ, the Nasdaq's maybe about 12, 13%. Bitcoin 50%. So there you go. We also have to look at Ethereum though, just to see what this compound annual growth rate is. Now this is the 2-year, I believe, the 2-year compound annual growth. Let's go to 4-year and see that. So this is the blue line right here. We'll get out of the way. The compound annual growth for Ethereum, if you hold for a 4-year period, is around 80%. So you can see that right here, around 80%. Now again, you have to go through a bunch of drawdowns, bull markets, bear markets. But if you fundamentally assume that Bitcoin and Ethereum are, have a market, they have users, they are growing over time, then we can start to make assumptions on how much we actually need to make returns above that. If you have a mix of Bitcoin and ETH, maybe your compound annual growth rate, 50, 60%, something like that, as of right now. Now, through cycles and as the assets mature, that is going to go down, but it's still wildly more than any other asset class. So if you want to outperform that and you want to grow your account more than 50% a year, then you're going to have to do some other things, and we'll get onto that right now. How can we outperform the market then? If Bitcoin is going up 50% a year, how can we get better returns than that? There's really only 3 ways to do this. The first is through market timing. That is trying to understand the economic cycle and the business cycle and trying to essentially buy more when prices are lower. Now, during a time where most retail investors actually flee the market, that is obviously usually the best time to buy. Even though it doesn't feel like it, it feels like the world's imploding during a recession and a bear market, it's of course the best time to buy, assuming that the assets that you actually own are secularly growing, right? So they have a long-term growth trajectory. Bitcoin seemingly does. Others do as well. Ethereum, maybe some NASDAQ stocks and everything like that. So we can time the market to actually buy more when prices are particularly lower. And that's obviously going to create some outperformance if we can manage our cash to make sure that we, don't put ourselves in any danger in terms of our lifestyle. The other one is asset selection. So the assets that you choose to buy are going to dictate how your portfolio performs. So if you want to buy the S&P and you want to take less risk, you're going to make 8% a year, because that's pretty much the value of currency debasement every year. If you want to buy NASDAQ, you open yourself to slightly more volatility. That tends to outperform because you've actually got some stocks in there that are actually growing faster than the rate of currency debasement. Bitcoin's growing at 50% a year, we've just seen. So asset selection is really important. Within cryptocurrency, you can choose assets that maybe even outperform Bitcoin and Ethereum over cycles as well. Are they great for the long term? Maybe not, but over cycles, they can definitely outperform. And so therefore, you have to get more active in your asset selection and management. There's some tips here that I'm going to show you as well. And then we can use leverage to just increase our bet size and hope that we're right. Again, this isn't really for everyone, but there are some specific strategies here which we'll go through. The first thing we can try and do is time the market and try and buy more when prices are lower. This is obviously very difficult because trying to time economic cycles with the data coming out is almost impossible. Economic data is very slow and lagging. The market usually moves much faster than that and then tries to anticipate it. The market can get things wrong, price something in that doesn't happen, and etc. However, we can look at this. Again, all links to all of this stuff I'll leave in the description for you. This is the leading economic indicators board, as you can see here, the conference board that do this. Now, usually during recessions, which are marked in gray, you can see the LEI really drop off, obviously trying to show us that the leading economic indicators are showing a potential recession. Now, recessions are obviously the best time to buy, but you have to make sure that you're buying in line with your own lifestyle, and so you're not putting too much cash to work, because obviously you have to hold through these recessions. So this is one piece of data that's fairly accurate in terms of showing us when drawdowns occur, when recessions occur, and markets tend to price this in. So during these times, as you can see, we're in one right now, it's usually the best time to actually pick up assets that are going to be successful after the recession. And of course, you have to pick your assets wisely. Maybe just an S&P index fund, NASDAQ fund, or something like Bitcoin if that's what you're into. As you can see here, buying them when prices are lower. Right here, these data points show us when that happens. And it doesn't happen all that often. You can see the 2008 crash was obviously a great time to buy NASDAQ and the stock market since then. When we've come down to this before, usually decent times to buy, and you can see 2019-20 with the COVID crash, again a great time to buy as assets sold off, and again here assets have also sold off. Now we assume that we come out of these and grow further, because that's what's happened over hundreds of years of data, is that eventually we come out of these recessions, the monetary base is debased again to try and push up asset prices, stimulate demand. So that's the fundamental assumption we're working on, is that we do eventually come out of these. And of course, if we don't, then, well, we've all got a problem anyway. The second data point we can look at is what's known as global liquidity. Now, global liquidity is essentially where central banks increase the size of their balance sheets because the governments are taking out lots of debt and trying to pump that into the economy through stimulus plans, infrastructure spending, etc. What that has the effect of, is debasing the currency, and that means asset prices usually go up in anticipation of that. And of course, they hope to stimulate growth within the economy, which should benefit assets generally as well. So as you can see, there's a big correlation here between the crypto market cap and gold and global liquidity. The correlation is quite strong. And as you can see, as liquidity draws down, that's not good for assets. That's recessionary, and asset prices usually fall. And when global liquidity is getting pumped up, asset prices usually go up as well, like I've just said. So what we can do here is go onto something like TradingView. TradingView, again, completely free. I'll leave a link to it in the description. There is a pro version if you want to have a look at that. For the most part, you can use it for free. So I've got some videos on TradingView as well. So if you want to check those out on how to use it, we're going to go to indicators here. I'm on Bitcoin, and then we just need to get an indicator of global liquidity. So one of these two, you can just type in global liquidity here and it comes up. One of these, and it will show you this down here. So I've got global net liquidity. Now you can see a very decent correlation between Bitcoin and global net liquidity. So right here, during the stimulus of the pandemic, huge amount of stimulus, government and central bank balance sheets exploded and net liquidity exploded, and that goes in line with what happened with BTC reaching a new all-time high. These aren't a coincidence. You can see as the global liquidity comes off, as central banks tried to tighten policy because things were getting out of hand, so did the Bitcoin price. Now, as of right now, the correlation between net liquidity globally and Bitcoin, gold, and assets really is very strong. And so we can't predict what's going to happen to it, over the short term, but you can see the correlation. And so when we see these drawdowns in net liquidity, that's usually a time to actually start thinking about the next part of the cycle. You're having cheap prices here. You're trying to time the market right. And so that's one of the main data points I would use to try and time the market, is seeing if global liquidity is coming off. And so asset prices, it's actually somewhere to be accumulating assets because they're relatively cheaper, hoping to time the next part of the cycle if you're trying to outperform a 50% CAGR for Bitcoin and 80% for Ethereum. Next, we can look at asset selection to grow our account. If you're looking for more than 50 or 80% compound annual growth over a 4-year period, then we can select some assets that maybe have higher growth than that. So just as an example here, this is where you start obviously trying to trade altcoins. Now with altcoins, the probability of loss is much higher, right? So if we look at 2017's biggest gainers, we can see a bunch of cryptos that pretty much haven't done anything since then, right? And they've been a nightmare. If you held those, you wouldn't have done very well, or you would have underperformed just holding Bitcoin, right? And so when you're trying asset selection and you're trying to buy altcoins that you think have some growth in them, the unfortunate reality is that about half or more, maybe 70% of them are actually not going to perform even as well as BTC and underperform the market generally over time. That means that you have to buy at least maybe 10, 12 of them, just to increase your odds of actually getting a few that are doing okay. Or you just stick to the ones that have done well over periods of years. Binance is doing well over time, but pretty much, and Ethereum as well, obviously, maybe you just stick to those. But if you're trying to get much higher returns, like you're going to have to beat Ethereum, right, at 80% CAGR. So you're looking for 100 plus, 150% plus CAGR. The risk that you're taking, means that if 5 of them go bust, you're going to have to get a few that are going up like a few 100%, which the math just doesn't really work out, to be totally honest. But there's other things we can do. The first one is we just have, 80% of our assets in Bitcoin and or Bitcoin and ETH. You can choose that, 10, 15, 20% in another strategy where we think we're buying some altcoins that may outperform during that cycle, or we have some NFTs or whatever you may want to do, whatever that's up to the individual right there. What is actually probably a better solution, in my opinion, rather than taking risk positions in other assets, is actually just to try and take advantage of something unique in cryptocurrency, which doesn't happen in any other market, right? And that is airdrops and launch pads, where it does happen in other markets, but most of the time you have to be a professional investor. And so a lot of people are frozen out of those opportunities. When I was broking, we did launch pads all the time. We didn't call them launch pads, we called them, placings and, coming to market, right, of stocks. Now, launch pads are the crypto version of that, where actually normal people can get involved just by having accounts. Now, a lot of this is a little bit of work and you may not think it's worth it. That's up to the individual. One that is live right now on Binance is called Sway. Again, I'm not saying that this is a good or bad blockchain or if it's going to perform well over time, but it's a launch pad, which means that you put up some of your assets and then you just get given free tokens and you can do with that what you want. Now, for right now, and I'm not advertising this or trying to say this is good or bad or anything, but as you can see here, if you have BNB or TUSD, which is a stable coin, you stake that in the launch pad and then you get some Sway tokens. Now that is some value given to you essentially for taking no risk if you have the stable coin, right? You're just staking the stable coin and getting some sway tokens back. There might be some terms and conditions here, but this is a way of essentially taking some of your assets and trying to get value rather than just taking risk in something and saying, I hope that goes up, and it has to outperform ETH at 80%. This is a way of actually getting a very high return from a risk standpoint. So that's one way of doing it, is launch pads. Now, again, like 90% of these are garbage anyway, and you don't want to be getting into them, but there are some opportunities short term. There's also airdrops as well. Arbitrum just had an airdrop. All you had to do was just use the chain a little bit, and you got anywhere from a few $100s up to like $8,000-$10,000 for the biggest airdrops. That's for not taking any risk, right? You just use some of the applications on there, move some money around and move some ETH around on the Arbitrum network, and you got an airdrop, right? So that is a way of taking pretty much very, very low risk. You've just got chain risk and, using the blockchain, but you're not just buying something and hoping. You're actually just using it, for a while, taking the money back out if you have ETH anyway, and then you could potentially get the airdrop. You can't get that in any other sector, right? It just doesn't happen. And so this is something that's genuinely could increase your account and actually grow your account by a big percentage just by looking at these. They aren't taking risk. They aren't investing as such. You're actually just using arbitrages from launch pads, tokens launching, selling them quickly, or airdrops, or even holding on to them if you want. So yeah, it's fairly difficult. You have to keep your eye on lots of things, but it is an opportunity to have rather than just trying to buy some coins that you hope, beyond all hope, are going to go up like 200-300%. The next way to try and outperform the market is to use margin or leverage, which is where you just borrow money from an exchange to make your investments larger. Now, obviously, this has a ton of downsides and few upsides unless you actually obviously get the timing right. But with leverage, you can go to an exchange, you can go to trade derivatives here. They're just crypto futures, which essentially track the price of Bitcoin, but obviously you're not buying and holding BTC or Ethereum or the other assets. You're just trading the prices of them. And so you put $1,000 on an account, you can get some leverage here, so 5x leverage. That means my $1,000, I can turn it into a $5,000 position. Now that's obviously a great way to outperform the market because you're gonna, go 5x leverage of whatever it is. The downside of this is futures are not really for investing at all. They're for short-term trading, mainly because when you borrow money, of course, you have to pay an interest rate. And of course, your money on the account is only there to fund losses. So if you're 5x leverage, then a 20% move to the downside is going to completely wipe out your trading account. You've got $1,000 in, $5,000 position, 20% move on that $5,000, your $1,000 is wiped out and all your money's gone. Is that the easiest way to grow a trading account? I don't think so. I think it's the easiest way to lose money, especially very quickly. But there are some strategies here. If you understand cycles and you use a little bit of leverage that you're comfortable with, maybe that's okay to go in with some trades here. And sure, that is a way to outperform, right? Instead of just buying and holding, you try and take positions around the edges. With crypto futures, you can take long positions, which is, benefiting from prices going up, but you can also take short positions as well, which is where you bet on prices going down. And as you can see, that is a way to outperform. This video isn't really about future trading strategies. I've got a bunch of day trading, short-term trading strategies, which I'll leave linked in the description. There is something that people do. As an investor, this is not suitable. It's not a suitable product. Leverage is obviously increasing risk. And so there's lots of strategies to try and reduce that risk, but it is very difficult. As we can see here from Bitcoin, if you go to indicators and then type in something called ATR, which is average true range, this gives us an indication of how much the price of an asset can move in any given time frame. For right now, I've got the month chart right here. This is the month chart for Bitcoin, and as you can see, it's a secular growth asset, right? But anyway, over a month, we can see that the ATR right here, you can just see that the ATR for BTC is around $8,000. You can see that right here. So $8,500. What that means is every month, Bitcoin on average can move $8,000 totally normally. And so if you're investing long-term with leverage, you can see that an $8,000 move may actually be basically stopping you out of your trades and all of your account is gone. So it's obviously difficult to try and analyze long-term. Using futures, using leverage is very difficult. Short-term, you can try and time cycles, and you can also use leverage on those cycles. if you want to try and outperform. But every time you try and outperform the market, you're just taking more and more and more risk. And when you take more risk, then you can potentially make obviously big losses, which really in a growth market like crypto, I think the way that you outperform most people and the easiest way to grow your account is just to stick around the longest. So make sure to don't overdo it with leverage, don't put yourself in a bad position. And also, not your keys, not your crypto. Take your crypto off exchanges, put them in a wallet, understand how they work. I've got some videos on that as well, which I'll link in the description. But staying around is the best way to outperform and the easiest way to grow your account, in my opinion. If you want to learn more about all of the on-chain analytics, economic cycles, Bitcoin cycles, my strategies, my portfolio, you can see all my trades. That's all in the Crypto Investor course. I'll leave it linked below. 300 plus videos, private Discord groups as well, with a lot of crypto investors. So you can get up to speed and learn from people that have been around for years in this space. You can check the details via the link in the description. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.